Get ready for a bumpy ride, because TripAdvisor stock has taken quite the tumble today. I'm talking about a multi-story roller coaster dive, folks. Let's break down why TripAdvisor has been making waves, and not the good kind, on the NASDAQ. All right, so TripAdvisor released their second quarter 2024 earnings report, and it wasn't pretty. First off, although they managed to top the adjusted earnings per share expectation by coming in at 39 cents versus the forecasted 37, their revenue wasn't up to par. They reported $497 million in revenue, missing the analyst consensus of $504.8 million. To put that in perspective, that's like promising a luxury cruise and delivering on a budget ferry. No wonder analysts are disappointed. Dive into the details, and things get even murkier. Despite an overall revenue boost of 1% year over year, individual segments told very different stories. Their Viator segment, which focuses on tours and activities, showed solid performance with a 13% revenue growth to $244 million. On the flip side, their core brand, TripAdvisor branded hotels, slid backwards, dropping 10% in revenue to $250 million. You win some, you lose some, right? But here's where it gets gnarly. Adjusted earnings may look cheerful at first glance, but a deeper dive reveals GAAP earnings of just 0.17 cents per share. No growth compared to last year? Not a good look. Add to this a nearly 60% decline in free cash flow, which plummeted to $37 million year over year, and you're starting to see why investors are rushing to abandon ship. Wall Street wasn't feeling optimistic either. Analyst reports came flowing in like stormy seas following the earnings announcement. Not one, not two, but 5 analysts reduced their price targets on Trip stock. It's now rated under a cloud of skepticism. Only one analyst dared to label it a buy, while 2 flagged it as neutral, and another 2 waved the dreaded sell sign. It's like a critical judge panel at a talent show, and TripAdvisor didn't make it past the auditions. TripAdvisor's own guidance added insult to injury. The company indicated that its revenue might be flat to even down in the third quarter, with profit margins set to shrink by about 350 to 450 basis points year over year. Talk about hitting them where it hurts. The skepticism around their future performance only makes matters worse, especially when you consider that the stock is priced nearly 100 times its earnings right now. So, to sum it all up, TripAdvisor's sky-high expectations have been grounded. Between the lackluster revenue growth, the concerningly flat earnings, and analysts' collective cold shoulder, it's no surprise that Trip shares plummeted about 11% and traded down more than 14% in pre-market. If you're wondering whether this stock is a buy or a fly-by-night, today's news made it pretty clear for most experts. It's a rough ride ahead. Stay tuned, because this story is far from over. Thanks for watching to the end. Remember, this is just one story from our full daily show, which includes all the other news and an analysis of the day's tech market activity. If you found this video interesting or insightful, then please like, subscribe, and share it with others. Your support is greatly appreciated. Catch you later.